Welcome to the Pro Ticker Deep Dive. We're diving into a market situation today that feels, well, both exciting and maybe a bit unnerving. You've got indices flirting with record highs,
Yeah.
and almost every little dip. I mean, tiny dips, they just get instantly bought up.
Right.
So the question isn't really if stocks are going up, it's more like, why? Is this momentum actually built on solid ground, like real fundamental strength?
Or is it just, the herd? Too much money, all chasing the same few momentum trades.
Exactly.
And that's our mission for this deep dive, really. We need to try and figure out how durable this whole structure is. We have to unpack investor positioning, see if this rally is genuinely based on corporate health, or if it's, like you said, just a symptom of capital flows concentrating heavily. We got to see who's leaning where.
Okay, so let's get the quick take up front. The analysis suggests a bit of a contradiction, doesn't it? What's the core finding? Are things stable, or are we maybe, surfing on borrowed time?
It's a really interesting mix, honestly. High conviction meets deep fragility. That's the headline. On one hand, investors are fully engaged. The research shows cash levels, well, they're historically low across lots of groups. People aren't sitting on the sidelines. Hedge funds, systematic models, retail investors, they're all leaning in. But that's also what creates the fragility. The big risk is how uneven this rally is. It's super concentrated, and that makes the whole thing vulnerable if something, shifts suddenly.
Right, okay, let's unpack that unevenness, because that feels like the key point, this sort of crack beneath the surface. This isn't some broad rally lifting everything.
No, definitely not.
It's targeted, very targeted. So who's getting picked and who's getting left behind here?
Exactly. When you dissect this rally, it's all about quality and, frankly, size. The money is pooling into very specific momentum pockets.
And the winners are pretty obvious, right? Mega cap tech, those quality growth names, companies with clean balance sheets, the clear growth stories. Our analysis also flags some specific asset choices that look like hedging, even with all the risk on sentiment. Gold's doing well.
Classic inflation hedge, still relevant.
And energy, too, benefiting from those supply issues.
Absolutely. But the real insight, I think, comes from looking at what's not working, the laggards. That's where the story gets interesting. Money is actively avoiding areas that usually do well in a healthy, broad recovery. Think about small caps.
We should be booming if the U.S. economy is strong, right?
Precisely. But they're struggling. And then look at defenses, utilities, healthcare, consumer staples, usually safe havens, but the money just isn't flowing there. It tells you the market's in this very focused, almost narrow risk-on mode. It's ignoring value unless it's in that sort of top tier.
And this focused risk appetite, it feeds on itself, doesn't it? That momentum feedback loop we always talk about.
It really does. The source material notes, momentum breeds momentum. As long as those systematic strategies keep buying based on price trends, this rally could keep running, maybe further than the fundamentals alone would suggest.
Okay, so that's the engine. But why is everyone leaning the same way? We need to lean out a bit, look at the bigger picture, the macro stage. It sounds choppy out there.
Yeah, choppy is a good word. Global growth feels like a three-speed engine right now, and the differences between those speeds, they have huge implications for capital flows.
And the U.S. is clearly in the fast lane, setting the pace.
Yeah, U.S. strength is key, the job market's holding up, consumer spending is resilient, surprisingly so in some areas. Corporate earnings have also been better than feared. So the narrative becomes U.S. assets are the place to be. They're attracting stronger flows than anywhere else. They're seen as the destination of least resistance globally.
But wait a second. If cash levels are already historically low in the U.S. market, are these assets really a safe haven? Or just the best bet available right now? Sounds more like maybe necessity driving flows, not just caution.
That is the tension. Absolutely. They're the best bet, partly because the alternatives look, sluggish. That brings us to speed two. Europe's grappling with pretty weak growth. Those energy concerns are still bubbling under the surface, and business sentiment is just flat. That lack of confidence, it pushes international money towards dollar assets, towards the U.S. market.
Okay, and speed three, the wild card.
That's Asia, specifically China. Beijing is trying to stabilize things with stimulus, policy support, but it's a real high-risk, high-reward situation. You've got markets there that look deeply undervalued. They could pop if the stimulus really kicks in, but they're also fragile if global demand weakens further. Investor confidence is still, let's say, cautious.
And layered over all of this is the whole inflation question, the policy debate. Inflation's cool, but it's proving sticky, right?
Very sticky. Core CPI prints are still high enough that central banks are, understandably, being super cautious about cutting rates too quickly. They don't want to reignite it.
Which means every single data point, CPI, wage growth, job numbers, suddenly has this huge importance.
Outsized importance, exactly. Investors are constantly tweaking their expectations for monetary policy based on every little flicker in the data.
And that repricing feeds right back into the flows we're talking about,
Yeah.
pushing capital towards that dominant narrative, U.S. large cap growth.
That macro uncertainty definitely encourages investors to cluster together. Which brings us back to the flow dynamics. Who exactly is driving this concentration? We can see three main groups. First, you've got hedge funds. They're adding long exposure pretty aggressively, but it feels driven less by deep value conviction and more by, well, FOMO, fear of missing out.
Right. They can't afford to lag if the market keeps ripping higher?
Exactly. And they're tilted heavily towards those mega cap darlings because they offer performance and liquidity. They need to be able to get out fast if things turn.
Okay, group two, the non-emotional players. The systematic strategies, the quants. How are these algorithms reading the current environment? What makes them buy?
Well, these are mostly trend-following models. They don't have feelings about the market. They react to price and volatility data. Right now, the signals are green, meaning price action is strong, momentum is positive, and volatility, while present, is reasonably contained. So a common trigger might be something like the price staying consistently above a key moving average, say the 50-day. When that happens, the models automatically buy more. They don't care much about valuation in that moment. They respond to the trend, and in doing so, they actually amplify it.
Okay, makes sense. And the third group?
Retail investors. After being a bit cautious maybe earlier in the year, they seem to be re-engaging. You see it in ETF flows, particularly into broad index funds or tech-heavy ones, and also in single stock buying.
And often chasing the same popular names the institutions are in.
Often, yes. It creates this powerful sort of unified wave of capital, all pushing in the same direction. And look how the commodity picture fits this. Gold is bought, yes, as that inflation hedge. Energy gets a bid from supply issues. But industrial metals, things like copper, they're lagging.
Which reflects those global manufacturing concerns, right? Europe and Asia worries.
Precisely. It confirms the macro picture we discussed. The demand isn't broad-based.
Okay, so let's pause and just acknowledge the opportunity here. This momentum machine, when it's working, it's powerful. The chance for outsized gains, especially in those quality tech names, is real. That feedback loop is, well, pretty amazing for traders who catch it right.
It is, no denying the potential upside. But, and this is big but, this is where we absolutely have to hammer home the risks. Because of this crowded positioning, it's incredibly fragile. The big danger. The exit door jam.
That phrase just sounds bad. Exit door jam. Like everyone rushing for a tiny door at once. Is that the idea?
That's exactly the idea. It's the fear of liquidity vanishing when you need it most. If sentiment suddenly flips, maybe because bond yields spike unexpectedly, or a couple of those key mega caps report disappointing earnings, or some geopolitical event spooks the market, then the reversal from systematic funds and nervous hedge funds could be almost instantaneous and violent. Everyone tries to sell at the same time, buyers disappear, and prices gap down hard. Liquidity just dries up.
And the fragility is magnified because of the narrowness we talked about. If it's just a handful of stocks holding everything up, if they stumble, there's nothing underneath to kind of cushion the blow.
Precisely. The rally is dangerously top-heavy. If those few leading stocks falter, there's no broad base of support from small caps or cyclicals ready to step in. The fall could be much steeper. And add to that, valuations are stretched. They're high, which means the margin for error is tiny.
So even a small earnings miss could get punished severely.
Absolutely, even for a fundamentally solid company. If buyers are already nervous or fatigued, and systematic selling programs kick in automatically on a technical break, the stock could get hammered simply because the setup is so sensitive.
Okay, so high potential reward, but the risk is concentrated, it's systemic, and it sounds pretty unforgiving if it turns. Let's bring it down to the trading desk level. Tactical awareness. What are the charts actually telling us right now?
The technical picture is pretty clear for now. The S&P 500 is basically glued to its upward trend line. Traders keep buying dips near the 50-day moving average. That's your medium-term trend guide.
So that 50-day is the key level to watch.
It's the first line of defense, definitely. The fact that pullbacks have been shallow and have respected that level shows there's still strong underlying buying pressure, strong confidence. Volume patterns also confirm the momentum story. You see higher volume on up days, lower volume on down days. Classic momentum signature.
And the NASDAQ, being dragged higher by that small group of tech giants, that's the perfect picture of this top-heavy market, isn't it?
It really illustrates it perfectly. Now, you'll hear people warning that momentum indicators like the RSI, the Relative Strength Index,
Yeah, measures price speed.
right, they'll say it's stretched or overbought.
Which normally means a pullback is due, doesn't it? Are the indicators just wrong this time?
They're not wrong exactly, but you need context. And this is important. Overbought can stay overbought for a long, long time in a really strong momentum phase like this. The real sell signals, the true turning points, probably won't come just from an indicator flashing red. They'll likely come from something more tangible breaking, like decisive breaks below those key moving averages we mentioned, especially the 50-day on heavy volume, or a sudden sharp spike in volatility, think the VIX index jumping significantly. That's the kind of event that could really trigger widespread systematic selling.
Okay, so don't just watch the RSI number in isolation.
No. Watch the price action, watch the support levels, watch the VIX. So wrapping this up, what does it all mean for you, the listener, trying to navigate this? It means this is absolutely not a market for complacency or for blind conviction, either way, frankly. Tactical awareness, agility, having very clearly defined risk points, those are essential right now because this market seems driven more by positioning and flows than maybe by deep fundamentals at this exact moment. That makes it exciting, yes, but also, as we've said, incredibly fragile.
It really does bring that surfing analogy to mind, but maybe with a twist. You don't control the ocean, right? The macro, the flows.
Right.
But the challenge here seems to be, if the underlying fundamentals aren't maybe as strong as the index levels suggest, isn't riding this incredibly narrow wave closer to, well, gambling than investing?
Yeah.
How do you manage that?
It forces a very high level of risk management discipline. You have to acknowledge the power of the wave, the momentum, but constantly respect the ocean's power to change suddenly. Keep your eyes on the horizon, watch those key levels, watch the macro data shifts, have your stops in place, know where you'll get out before you get in, and be ready to bail mentally and operationally the moment that wave starts showing real cracks.
So let's leave our listeners with a provocative thought to chew on this week. If positioning and flows are really steering the ship right now, what specific non-technical macro event, like a real-world data surprise, do you think would be the most likely trigger?
Yeah.
The thing that flips those hedge fund and systematic flows from tailwinds into, sharp, sudden headwinds. Would it be, say, a surprisingly low inflation number, suggesting the Fed might cut sooner than expected? Or maybe the opposite, a sudden sustained spike in the 10-year Treasury yield that makes borrowing costs jump? What breaks this momentum machine first?
Thinking through that specific scenario, what that trigger might be and how you'd react, that's probably the most valuable preparation you can do right now.
See you all in the next Pro Ticker Deep Dive.